Hey there, my name is Nomi, and today I'm excited to share with you how I've built a multi-six-figure portfolio of 7 passive income investment assets by the age of 23, and how you can do the same. These investment assets not only beat inflation, but also offer tax advantages. But before we dive into the details, let me address a crucial aspect of wealth building. Investments alone won't make you rich. When I say investment, I don't mean active investors like Warren Buffett or day traders, okay? That's why many successful business owners and entrepreneurs online nowadays emphasize the importance of acquiring high-value skills and building cash-flowing businesses, and I couldn't agree more. In fact, I've previously created a video guiding you on how to choose a profitable business to start, and you can find the link right here in the corner and down below in the description. That being said, it's important to remember that the value of money can depreciate over time due to inflation. Your hard-earned cash can lose value due to inflation if just sitting there. That's where investments come into play. These are investments that not only beat inflation, but also provide passive income. You don't necessarily need to put in excessive time or energy, just like your investments work for you. I too don't spend too much time or energy micromanaging my investment assets. They're quietly growing in the background, and it's pretty great knowing that my money is making money for me. Plus, many of these assets come with fantastic tax advantages. So, while you focus on building your businesses, also educate yourself about investments. Once you have got your investment portfolio up and running, you'll only need occasional adjustments. This peace of mind allows you to focus on your business empire, which is the real wealth generator. There will be tons of insights and knowledge in both the business and investments videos, so be sure to grab your notepad and watch until the end. Without further ado, let's get started. My first investment asset is high-yield savings and certificates of deposit. Many people make the mistake of stashing their savings in low-interest savings or checking accounts. I've known many young people who are still using their low-interest college student accounts years after graduation. If you're one of them, it's time to make a change. Open a high-yield savings account today. A high-yield savings account can offer interest rates up to 10 to 12 times the national average of a standard savings account. As of the recording of this video, the best high-yield savings accounts are offering around 5% APY, which is more than 12 times the FDIC's national average for savings accounts. Back in my college years, I didn't have much financial knowledge, and I regretted putting my hard-earned money into a student checking and savings account with less than 1% APY. So I learned the hard way. For the past few years, regardless of market interest rates, I've made sure to place my cash in accounts with at least a 4% APY. Another high interest rate option is certificates of deposit, or CDs. CDs are low-risk, time-bound investments. They offer fixed interest rates over a specified term, typically ranging from a few months to several years. Unlike savings accounts, which allow easy access to your funds, CDs have limited liquidity and may incur penalties for early withdrawal. Since high-yield savings accounts and CDs may not offer as high returns as riskier investments, I use them not for aggressive growth, but primarily as a secure way to park some of my cash, such as emergency funds, while still generating good returns. My second investment asset is stocks. When we invest in stocks, we become partial owners of a company. Personally, I own stocks in high-growth, highly profitable companies with strong economic moats, such as Apple, Microsoft, Amazon, and Meta. There are various ways I make money from stocks. The first way is through capital gains. When the price of a stock rises, I sell it at a higher value, making a profit. Note that capital gains can be either short-term, which is taxed at your regular income rate, or long-term, which comes with lower tax rates. Nowadays, since I would like to focus more on building my business, I prefer holding stocks for long-term growth rather than trading them frequently, which also saves me from higher short-term capital gain taxes. The second way I earn income from stocks is through dividends. Some companies distribute a portion of their profits to shareholders in the form of dividends. These payouts can provide a consistent passive income stream. I personally like to reinvest my dividends back into the stocks as well. The third way I make money from stocks, which I used to do more in the past, is through options trading. Options are more advanced and complex. They give you the right to buy or sell a stock at a specific price called the strike price before an expiration date. Options can be used for various strategies, from speculating on stock price movements to hedging against potential losses. Two fundamental types of options are calls and puts. Some of my favorite strategies that generate passive income for my stock positions are selling covered calls, selling cash secure puts, and rolling options. Now, since we're talking about stocks, which leads me to my third investment asset, index funds and ETFs. If you prefer a diversified approach and don't have the time or energy to research individual stocks, index funds and ETFs are excellent choices. These allow you to invest in a broad selection of stocks. Alright, so here are some popular and classic ETFs, some of which I personally own. For example, the QQQ ETF tracks the performance of the Nasdaq 100 index, which includes the 100 of the largest non-financial companies listed on Nasdaq. It's an excellent choice for tech-heavy investments. FXAIX, Fidelity 500 Index Fund, aims to replicate the performance of the S&P 500 index, providing exposure to 500 of the largest US companies. It's a solid choice for those looking for stability and growth potential. The OO Vanguard 500 Index Fund ETF is another popular option that tracks the S&P 500. If you prefer even broader market exposure, there are also funds that track the performance of the total US market, not just the 500 largest companies. For example, there is FSKX, Fidelity Total Market Index Fund, and VTI, Vanguard Total Stock Market ETF. These funds I just mentioned typically have annual expense ratios that are lower than actively managed funds, which can help you keep more of your investment returns. Over the long term, index funds have historically provided competitive returns compared to individual stock picking. For example, the S&P 500 index has returned a historic annualized average return of around 10%, surpassing the annual inflation rate in the US, which is approximately 3% in 2023. So if you would like to sleep better at night without worrying about individual stock performance, as well as focus on your revenue-generating business like what I do nowadays, consider index funds and ETFs for long-term investments. The fourth investment asset I own is bonds. Bonds are essentially loans you give to governments or companies. When we buy a bond, we're lending our money to a government or corporation in exchange for periodic interest payments and the return of the bond's face value when it matures. Keep in mind that bond prices and interest rates have an inverse relationship. This means that when interest rates rise, bond prices tend to fall. And when interest rates fall, bond prices tend to rise. Government bonds are often considered a safer option, backed by the government itself. For example, there are treasury bonds, also known as T-bonds, with the longest maturity, treasury notes, also known as T-notes, with intermediate maturities, and treasury bills, also known as T-bills, with the shortest maturity, usually ranging from a few days to 1 year and are often used as short-term cash equivalents. Corporate bonds, on the other hand, involve lending money to corporations. They typically offer higher interest rates than government bonds, but come with a bit more risk. An example is LQD, which tracks investment-grade corporate bonds. Bonds are generally a lower risk, lower return investment compared to stocks. As I'm currently at an early stage in my life and seeking higher growth, I have a more substantial allocation in stocks than in bonds. Number 5. Real estate. There are many ways to invest in real estate, such as owning a home, rental properties, or flipping houses. However, many of these require significant capital, time, and effort. Personally, I don't currently own an entire real estate property due to personal reasons. Still, if I did, I could generate revenue from rental income and appreciation of the real estate's value. However, currently, I do invest in real estate. How is this possible? That is through real estate investment trusts, also known as REITs, as well as fractional real estate. REITs are companies that own, operate, or finance income-producing real estate. When we invest in the REITs, we're buying shares in the REIT company itself, not in specific properties. Investing in REITs allows us to receive dividends from the rental income and capital appreciation of the underlying properties. We can buy shares in the REIT just like we would with stocks. Some examples of REITs include VNQ, Vanguard Real Estate ETF, and FRESX, Fidelity Real Estate Investment Portfolio. On the other hand, fractional real estate allows us to directly co-own specific properties with other investors. Instead of owning the entire property, we only own a fraction of the property. Popular fractional real estate platforms, for example, include ARC7 and Arrived Homes. Number 6. Tax-advantaged retirement accounts. Technically, they are not investment assets themselves, but they are special accounts that you can invest in stocks, bonds, and funds with great tax benefits and can play a huge role in your investment portfolio. Traditional and Roth IRAs are for individuals. 401ks are offered by employers, and solo 401ks and SEP IRAs are for the self-employed. Traditional IRAs and 401ks allow you to contribute money pre-tax, reducing recurrent taxable income. You'll pay taxes when you withdraw the money, including contributions and capital gains at retirement. Roth IRAs and 401ks, on the other hand, are funded with after-tax dollars, so you won't get an immediate tax break. However, your withdrawals, including contributions and capital gains at retirement, are tax-free. It's like planting a tax-free money tree. 401k plans are the employer-sponsored retirement accounts. You can contribute a portion of your pre-tax income to them, and your employer may match your contributions up to a certain limit. It's like getting free money for your future. Similar to what I mentioned at the beginning of the video, retirement accounts won't make you rich, as many successful entrepreneurs say. However, one of the biggest money mistakes I see among young people, especially those who are just a few years into their careers, is that they forget or have no knowledge about setting up their 401k from their employer and miss out on all that free money that their employer would match. Some companies can provide a 50% to 100% match and even a 200% match. Why turn away free money worth thousands of dollars when you're already working so hard for your employer? And why miss out on so many tax savings that the government literally offers you? Personally, I have a mix of pre-tax and after-tax contributions to my 401k. The reason is that I would like to have some immediate tax breaks now, so I contribute a bit in pre-tax. However, I also anticipate that my tax bracket could be much higher near retirement, so I would like to have more tax-free withdrawals and growth, which is why I personally also make numerous Roth and after-tax contributions more than the amount of pre-tax contributions. Number 7. Health Savings Accounts, HSAs. HSAs are designed to help us save and invest for medical expenses. Like retirement accounts, HSAs are also special accounts where we can invest in stocks, bonds, and funds. They even offer a triple tax advantage. First, contributions to an HSA are pre-tax, reducing your taxable income for the year. Second, investments held within an HSA can grow tax-free, which means you won't owe taxes on the earnings. Third, withdrawals from an HSA are entirely tax-free when used for qualified medical expenses. Typically, when you have an HSA, you'll be provided with an HSA debit card that you can use for eligible medical expenses. These expenses can include doctor's visits, prescriptions, dental care, and even feminine hygiene products. Note that HSAs are typically available only to individuals with a high deductible health plan, HDHP. I personally get my health plan and HSA through my employer. So if you are currently working for a company or employer, please go check if they provide one. Some companies might even match some of your HSA contributions, which means free money again. I basically invest in some S&P 500 index funds and Apple stock in my HSA and forget about it. The last time I checked, it had grown about 20% in return, which is pretty impressive. Hope you have learned something. If this content has resonated with you, please take a moment to share your thoughts in the comments section below. Don't forget to hit the like button and subscribe for more content like this. Your feedback and support mean the whole world to me. I appreciate each one of you, and I'll see you in the next video. Bye!